Look, I need to show you something that's happening right now in the silver market that most people are completely missing. And when I say most people, I mean the vast majority of investors who think they understand precious metals but are about to get blindsided by what's coming. Silver just hit record highs, and here's what nobody's talking about. We're now in the fifth consecutive year of a structural supply deficit. Fifth year. That means for 5 years straight, the world has been consuming more silver than it's been producing. And the gap isn't closing, it's widening. Let me put this in perspective. The silver market is facing a deficit of 820 million ounces over these 5 years. That's not a typo. 820 million ounces that simply don't exist to meet demand. And yet somehow the price is still trading at levels that make absolutely no sense when you look at the fundamentals. You want to know why they call silver the devil's metal? Because it's the most manipulated, most misunderstood, and most explosive asset in the entire precious metals complex. And right now, we're watching the setup for what could be the biggest move in modern market history. Here's what's actually happening on the ground. Industrial demand for silver accounts for 58% of total consumption. We're not talking about jewelry or investment coins. We're talking about photovoltaics, electric vehicles, AI components, wind turbines, 5G infrastructure. This is the metal that makes the modern world function. And every single one of these industries is expanding at an exponential rate. Think about electric vehicles for a second. Each EV uses between 25 to 50 grams of silver in its electrical systems. Doesn't sound like much, right? But when you're talking about millions of vehicles being produced every year, and that number is projected to grow to tens of millions, you're looking at thousands of tons of silver being pulled out of the market annually just for this one application. And here's the kicker. Unlike gold, silver gets consumed. When you use silver in a solar panel or an electrical contact, it's gone. It's not sitting in a vault somewhere waiting to be recycled. It's dispersed. It's used up. It's economically unfeasible to recover. This is a one-way street. Now let's talk about what's happening with supply. Global silver production is not keeping pace. Mining companies have been underinvesting in new silver projects for years because the price has been suppressed for so long that it hasn't made economic sense to develop new mines. You can't just flip a switch and create a new silver mine. It takes 7 to 10 years from discovery to production. The supply that's coming online today was planned a decade ago when nobody saw this demand explosion coming. And here's something that should terrify anyone who understands market dynamics. Primary silver mines, mines that exist specifically to extract silver, only account for about 30% of global supply. The other 70% comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal prices drop or those mines become uneconomical, silver supply drops with them, regardless of what silver's price is doing. You're starting to see the problem here, right? Demand is exploding, supply is constrained, and we're already 5 years into a deficit that's eating through above-ground inventories at an alarming rate. But wait, there's more. And this is where it gets really interesting. Central banks around the world are quietly accumulating precious metals at record levels. Now, they're primarily focused on gold, but here's what most people don't understand. The gold-to-silver ratio, which historically has averaged around 15 to 1 or 20 to 1, is currently sitting at levels that are completely disconnected from reality. When gold moves, silver moves harder. It's more volatile, more explosive, and when the momentum shifts, it shifts violently. Look at what happened in the last major precious metals bull run. Silver went from under $10 an ounce to nearly $50 in less than 3 years. That's a 5x move. Gold, during that same period, went from around $800 to $1,900. Still impressive, but silver absolutely demolished it in percentage terms. And here's why that matters right now. We're seeing the exact same setup, but with fundamentals that are exponentially stronger. Back then, we didn't have the industrial demand story. We didn't have the green energy revolution. We didn't have the EV boom. We didn't have AI infrastructure requiring massive amounts of silver for data centers and computing components. Let me tell you about something that's happening right now in the COMEX, the major commodities exchange where silver futures are traded. The amount of physical silver backing those paper contracts is at historically low levels. We're talking about a situation where if even a small percentage of contract holders demanded physical delivery, the entire system would seize up. There simply isn't enough metal to deliver. This is what's known as a fractional reserve system, and it works great until it doesn't. Until someone yells fire in a crowded theater and everyone tries to get out at once. And there are signs that this is exactly what's starting to happen. Large institutional players are starting to take delivery of physical metal. They're not rolling their contracts forward. They're not settling in cash. They're demanding the actual silver. And every ounce that leaves the COMEX vaults is one less ounce available to satisfy the next delivery request. You want to know what happens when a market that's been suppressed by paper trading suddenly has to confront physical reality? You get a short squeeze of epic proportions. You get a price discovery event that makes previous moves look tame by comparison. Now, I know what some of you are thinking, but silver's already up significantly. Haven't I missed the move? And that's exactly the kind of thinking that keeps people on the sidelines while generational wealth transfers happen right in front of them. Let me show you something. When silver hit its previous all-time high back in 1980, adjusted for inflation, that would be equivalent to over $150 per ounce in today's dollars. We're currently trading at a fraction of that. And remember, the fundamentals today are exponentially stronger than they were in 1980. Back then, it was purely a monetary play. It was the Hunt brothers trying to corner the market. It was inflation fears and geopolitical uncertainty. Today, we have all of that, plus an industrial demand story that's unprecedented in the history of the metal. Think about the green energy transition that governments around the world have committed to. Solar panels are one of the largest consumers of silver, using about 20 grams per panel. The International Energy Agency projects that solar capacity needs to triple by 2030 to meet climate goals. Triple. That's not a small increase. That's an exponential surge in demand for a metal that's already in deficit. And it's not just solar. Wind turbines use silver in their electrical systems. 5G networks require silver for their infrastructure. Medical applications use silver for its antimicrobial properties. The list goes on and on. Here's something else that's flying under the radar. The geopolitical dimension of this story. As tensions rise between major powers, as de-dollarization accelerates, as countries look for ways to protect their wealth outside the traditional dollar-based system, precious metals become increasingly important. China has been accumulating gold at record levels. Russia has been doing the same. The BRICS nations are talking about a commodity-backed currency. Whether that actually happens or not is almost irrelevant. What matters is the signal it sends. The world is losing faith in fiat currencies, and they're looking for real assets with intrinsic value. And here's where silver becomes incredibly interesting from a wealth preservation standpoint. Gold is the king of precious metals, no question. But silver is the people's metal. It's more accessible, more affordable, and historically, it's been the metal that ordinary people could accumulate to protect their purchasing power. You know what's fascinating? Throughout history, during times of currency crisis, silver has often been more useful than gold for everyday transactions. Gold is great for storing large amounts of wealth, but try buying groceries with a gold coin. Silver, on the other hand, has always been the medium of exchange for regular commerce. Now, I'm not saying we're heading for some apocalyptic scenario where you'll need silver coins to buy bread, but I am saying that having a portion of your wealth in physical assets that have maintained value for thousands of years is not a crazy idea. It's actually the prudent thing to do when you look at the trajectory of monetary policy and government debt levels around the world. Speaking of wealth preservation, if you're sitting on a significant retirement account, $100,000 or more, there's something you should know about. I've put together a comprehensive guide on how gold IRAs work, how you can get physical precious metals into your retirement account without triggering tax penalties. It's completely free, links in the description. It covers the mechanics, the custodians, the storage requirements, all the stuff you need to know if you're thinking about diversifying your retirement savings into physical assets. Worth checking out if that's relevant to your situation. All right, back to what's happening in the silver market right now. Let's talk about the supply side in more detail because this is where things get really concerning for anyone who's not positioned in this market. The average grade of silver ore being mined today is declining. That means miners have to process more rock to get the same amount of silver. That increases costs, which means at current prices, many deposits aren't economical to develop. And here's the thing about mining. It's not like you can just decide to produce more silver because the price goes up. There's a massive lag time. From the moment you discover a deposit to the moment you're actually producing metal, you're looking at close to a decade in most cases. You need to do exploration, feasibility studies, environmental assessments, secure financing, build infrastructure, develop the mine. It's a long, expensive, complicated process. So even if silver prices doubled tomorrow, which would make a lot of marginal deposits economical, you wouldn't see that supply hit the market for years. Meanwhile, demand continues to grow every single quarter. Let me give you a specific example of how tight this market is getting. The Silver Institute, which tracks global supply and demand, is projecting that demand will hit 1.12 billion ounces this year. Total mine production? Around 830 million ounces. That's a gap of nearly 300 million ounces that has to come from somewhere. Where does it come from? Above ground inventories? Recycling? Government stockpiles being drawn down? But here's the problem. Those sources are finite. You can only draw down inventories for so long before they're gone. And unlike gold, where there's an enormous amount of above-ground stock that's been accumulated over centuries, silver inventories are relatively small because, again, it gets consumed in industrial applications. There's a concept in commodities trading called days of consumption. It measures how long current inventories would last if all production stopped. For most commodities, you're looking at 60 to 90 days. For silver, we're talking about a fraction of that. The market is that tight. And here's what happens in tight markets when a catalyst hits. Prices don't move in a linear fashion. They gap, they spike. They move in ways that seem irrational until you understand the mechanics of what's happening. Buyers panic, sellers disappear, and the price has to move dramatically to bring the market back into balance. We've seen this movie before in other commodities. Remember what happened with palladium a few years ago? It went from around $500 an ounce to over $3,000 in less than 2 years because of a supply deficit driven by automotive demand. Silver has a similar setup, but with even more diverse demand drivers. Now let's talk about the paper market versus the physical market, because this is crucial to understanding what's coming. The vast majority of silver trading happens in the paper market: futures contracts, ETFs, derivatives. These are claims on silver, not actual silver. And the ratio of paper claims to physical metal is estimated to be somewhere between 100 to 1 and 250 to 1, depending on who you ask. Think about what that means. For every ounce of physical silver that actually exists in vaults backing these contracts, there are potentially 100 to 250 ounces worth of paper claims. This works fine in normal times because most people settle in cash. They don't take delivery. But what happens when confidence in the paper market breaks down? What happens when people start demanding physical delivery? You get a squeeze. You get a situation where the price of physical metal starts trading at a significant premium to the paper price. You get delays in delivery, you get contract defaults, and ultimately, you get a repricing of the entire market to reflect physical reality rather than paper fiction. There are already signs this is starting to happen. Premiums on physical silver coins and bars have been elevated for months. Delivery times from major dealers have been extended. The spread between the spot price and what you actually pay for physical metal has widened significantly. This is the market telling you something. It's telling you that there's a disconnect between the paper price and the physical reality. And when that disconnect becomes too large, something has to give. Let me tell you about what happened in March 2020 during the COVID panic. The silver market completely seized up. You couldn't buy physical silver at anywhere near the spot price. Premiums went to 50%, 60%. Even 100% over spot in some cases. Dealers were out of stock. Mints couldn't keep up with demand. And this was with the spot price actually dropping because of forced liquidation in the paper market. That was a preview. That was a stress test that showed just how fragile the physical supply chain is. And the market is even tighter now than it was then. Here's another angle that most people aren't considering: the role of silver in the coming technological revolution. We're not just talking about current applications. We're talking about emerging technologies that are going to require massive amounts of silver. Artificial intelligence infrastructure requires enormous amounts of computing power, which requires enormous amounts of electrical connectivity, which requires silver. Data centers are being built at a record pace to support AI development. Each one of these facilities uses tons of silver in their electrical systems. The Internet of Things, where everything from your refrigerator to your car to your thermostat is connected to the internet, requires billions of sensors and electrical connections. Silver is the most conductive metal on Earth. It's irreplaceable in many of these applications. 5G networks, which are still in the early stages of deployment globally, require significantly more infrastructure than 4G. More cell towers, more antennas, more electrical connections, all of which consume silver. And here's the thing. These aren't speculative technologies that might happen someday. These are technologies that are being deployed right now, at scale, around the world. The demand is real, it's growing, and it's not going away. Now, let's talk about the monetary aspect of silver, because this is where things get really interesting from a wealth preservation standpoint. Throughout history, silver has been money. Not a commodity that could be used as money. Actual money. For thousands of years, silver coins were the primary medium of exchange for commerce. The US dollar itself was originally defined as a specific weight of silver. A dollar was literally a silver coin. The paper currency was just a receipt, a claim check for the silver held in the treasury. That connection was severed in 1964 when the US stopped minting silver coins for circulation, and it was finally completely broken in 1971 when Nixon closed the gold window. But here's what's fascinating. Even though silver is no longer officially money, it still behaves like money during times of monetary stress. When people lose faith in fiat currencies, when inflation accelerates, when geopolitical tensions rise, silver prices tend to surge. And we're seeing all of those conditions right now. Inflation, despite what official statistics say, is eroding purchasing power at an alarming rate. Government debt levels are at historic highs with no plan to address them. Geopolitical tensions are escalating on multiple fronts. The conditions are perfect for a flight to real assets. Here's something that should concern anyone paying attention. The velocity of money is starting to pick up. For years after the 2008 financial crisis, central banks printed trillions of dollars, but that money mostly stayed in the financial system. It didn't flow into the real economy, so we didn't see massive consumer price inflation. But that's changing. The money is starting to move. It's starting to flow into goods and services. And when that happens, when all that liquidity that's been created over the past 15 years starts chasing a relatively fixed amount of goods, prices go up. And they don't go up in a controlled, manageable way. They go up in a way that destroys purchasing power and forces people to look for alternatives to protect their wealth. Silver, along with gold, has been that alternative for thousands of years, and there's no reason to think this time is different. Let me give you some historical context. In 1971, when Nixon closed the gold window and the dollar became a pure fiat currency, silver was trading at around $1.50 an ounce. By 1980, it hit $50. That's a 33x move in less than a decade. What drove that? Inflation fears, currency debasement, and a loss of confidence in the monetary system. Sound familiar? In 2008, during the financial crisis, silver dropped to around $9 an ounce as everything was being liquidated. By 2011, it was at $49, another 5 times move in 3 years. What drove that? Massive monetary stimulus, quantitative easing, and fears about the stability of the financial system. We're seeing the same patterns today, but with fundamentals that are exponentially stronger. We have the monetary story, the inflation story, the geopolitical story, and on top of all that, we have an industrial demand story that's unprecedented. This is not just about one catalyst. This is about multiple powerful forces converging at the same time, all pointing in the same direction: higher silver prices. And here's what most people don't understand about silver. When it moves fast. It's not a slow, steady grind higher. It's explosive. It gaps up. It has days where it moves 10%, 15%, 20%. And by the time most people realize what's happening, they've already missed a significant portion of the move. That's why positioning matters. That's why understanding what's happening before it becomes obvious to everyone else matters. Because once it's obvious, once it's on the front page of every financial publication, the easy money has already been made. Right now, we're still in the early stages. Yes, silver has moved up significantly from its lows. But when you look at the fundamentals, when you look at the supply-demand dynamics, when you look at the historical precedents, we're nowhere near where this could go. Some analysts are projecting silver could hit $100 an ounce within the next few years. Others are even more bullish, pointing to the supply deficit and suggesting we could see prices that would have seemed absurd just a few years ago. I'm not going to make specific price predictions because markets are unpredictable and anything can happen in the short term. But what I will say is this: the risk-reward setup in silver right now is as compelling as I've seen in any market. The downside is limited by the cost of production and the industrial demand floor. The upside is potentially massive if even half of what we're discussing plays out. And here's the beautiful thing about silver from a retail investor standpoint. It's accessible. You don't need to be a billionaire to accumulate a meaningful position. You can buy physical coins in bars. You can buy shares in silver mining companies. You can buy ETFs that hold physical silver. There are multiple ways to get exposure depending on your risk tolerance and investment goals. But here's what you can't do. You can't ignore what's happening. You can't pretend that the fundamentals don't matter. You can't assume that the paper price reflects the true value of the metal when there's a massive disconnect between paper claims and physical reality. The silver market is sending signals right now that are impossible to ignore if you know what to look for. The supply deficit, the industrial demand growth, the tight physical market, the elevated premiums, the declining inventories, the geopolitical tensions, the monetary instability. These aren't random data points. They're pieces of a puzzle that, when you put them together, paint a very clear picture of what's coming. And the question you need to ask yourself is, am I positioned for what's coming, Or am I going to be one of the people who looks back in a few years and says, I saw all the signs, I knew what was happening, but I didn't act? Because that's what happens in markets. People see the opportunity, they understand the fundamentals, but they hesitate. They wait for more confirmation. They wait for the perfect entry point. And by the time they're ready to act, the opportunity has passed. Silver is not just a commodity. It's not just an industrial metal. It's not just a monetary asset. It's all of those things combined, and that's what makes it so powerful as an investment and as wealth insurance. When you own physical silver, you own something that has intrinsic value, something that can't be printed by a central bank, something that can't be devalued by government decree, something that has maintained its purchasing power for thousands of years across every civilization that's ever existed. That's not speculation. That's not hopium. That's historical fact. And in a world where currencies are being debased, where debt levels are unsustainable, where geopolitical tensions are rising, where the financial system is more fragile than most people realize, having a portion of your wealth in real assets isn't just smart. It's essential. The silver market is at an inflection point. The fundamentals have never been stronger. The supply-demand dynamics have never been tighter. The catalysts for a major move have never been more numerous or more powerful. This is not financial advice. I'm not telling you what to do with your money, but I am telling you to pay attention, to do your own research, to understand what's happening in this market. Because what's coming is going to be significant, and the people who are positioned for it are going to do very well. The wealth insurance policy you need today isn't from some insurance company. It's not a financial product with fees and fine print. It's physical silver. It's the metal that's been money for thousands of years that's essential to modern technology, and that's in a supply deficit that's getting worse every year. The question isn't whether silver is going higher. The question is how much higher and how fast. And the answer to that question is going to depend on how quickly the market wakes up to what's really happening. Don't wait for everyone else to figure it out. By then, it'll be too late.